Hi, welcome back to another video. Today we're going to analyse Google, ticker symbol GOOG and GOOGL. Google doesn't really need an introduction. The holding company isn't actually called Google, it's called Alphabet, but we're going to refer to them as Google in this video. Our aim in this video is going to be to calculate intrinsic value for Google and decide whether it is a good investment today at the current price. But first we need to understand Google's business operations and its addressable market, and then determine what the catalyst for growth or decline might be in the future. Firstly, let's start with what we're looking for. So what we're going to be looking for in Google is top line growth and potential to continue growing in the foreseeable future. Also earnings growth and stable margins, the ability to convert earnings into free cash flow, a healthy balance sheet with little or no debt, clear and long-lasting competitive advantage and economic moat, high returns on capital, good management, and a reasonable stock price. So let's get started. Google's revenue sources. Let's see what makes up Google's revenue. So as you can see, advertising is far and away the biggest revenue generator for Google. Google's search engine and YouTube make up the majority of this revenue, with YouTube actually reaching $15.5 billion in revenue in 2019 and still growing at a 30% rate year over year. A huge landmark for Google, who bought it in 2006 for $1.6 billion. What an investment that's turned out to be. Cloud services unit makes up 6% and it reached $9 billion in revenue in 2019. It's the fastest growing segment of the business at 50% year over year. It will no doubt become a larger part of Google's overall revenue in the next 5 to 10 years. Other revenue is made up of non-advertising revenues such as premium products, YouTube TV, YouTube Premium, Google Store, Android, etc. This segment of the business is also growing, although not at an above average rate when compared to the rest of the business. Other bets are some small bets that Alphabet has made or Google's made that may or may not become something. They tend to be small, high reward, high uncertainty bets that could be classed as highly speculative in my opinion. Revenue and earnings growth. As you can see from the chart, Google has achieved tremendous growth, both top and bottom line. 5-year, 20% compound annual growth rate for a mature company is best in class. To see such consistent growth trends over a 10-year period is rare. You only really see it in extremely good companies that have a significant competitive advantage. Now, you can see they have experienced some short-term stagnation this year due to advertising being down due to the pandemic, but even so, they haven't declined in either top or bottom line metrics. That's really a sign of a defensive company right there. Consensus estimates in 2021 estimate that Google will reach $200 billion in revenue by then. It seems achievable, but if we had $1 or £1 for every time an analyst was wrong, we wouldn't even have to invest, to be honest with you. But that's a good number, a good estimate to have and keep in the back of our minds. I put the growth trend line in there to show you, just because top line growth rate is trending down obviously for 2019 to 2020, but it doesn't necessarily mean it can't rise again. If we look at 2015, you see how it dropped to just under 15%, 13.6, and actually started rising again. So just because it's trending down doesn't mean it won't go back up. We'll have to look at what catalysts are there. EBIT and pre-tax income margin never really strays away from that 25% that they're averaging. Although it's possible, I feel Google obviously has a well-established business operation. They're very reliable in terms of profitability, and they don't have any debt obligations and things like that might bring it under pressure in the future. Earnings have grown at 18% compounded over the last 5 years. Again, another fantastic number for a mature, well-established company. Free cash flow. I thought I'd give free cash flow its own slide just because of the individuality it has compared to the rest of Google's metrics. It really grows in a non-linear fashion, so which is dissimilar to the rest of Google's other metrics. This is probably due to fluctuations in invested capex such as R&D and things like that, but we'll get into that in a bit. Although the progress is not always linear, it's managed to achieve tremendous growth for such a large company, with 23% compounded over 5 years. Free cash flow margin has averaged 21% for the period. We'll be factoring this into our assumption and cross-checking it, but it will not be the prime estimator for free cash flow. We're going to use a sales cap ratio method instead, due to the cyclicality of the free cash flow, as you can see here on the chart. This should allow us to get a better average for the free cash flow going into the future and provide a more accurate estimate. Google's balance sheet or liquidity position: if you don't want to lose money, put it in Google and hold. It is a cash cow and self-sustaining. As you can see, it pretty much runs off of the cash that it produces from its operations, and has done for a long period of time. It's hard to run into any financial trouble when your cash on hand is 10 times your total debt, and annual EBITDA is 5 times your total debt. So with this, they've got the ability to make big acquisitions when the time is right that may play a role in future growth or the expansion of the business. They also would have the ability with this amount of cash to buy back a lot of shares, lifting the stock price, but we'll get into that in a moment. Shareholder equity has grown at a similar rate to earnings, at just above 17%, which is always good to see. This gives us an indication of how quality the growth was, i.e. not using debt to grow. Google's current ratio is 3.4, very, very healthy number, meaning that current assets are 3.5 times higher than current liabilities. Economic moat and competitive advantages, really. This is an important step in the valuation process that we haven't really covered too much before, although we've touched on it. But we're going to try and dive a little bit deeper than just the numbers here and think about what gives Google such a large moat, and go beyond just the quantitative data. Now, in terms of Google's competitive edge and economic moat, really, it's got probably one of the largest economic moats I can think of, if I'm honest. One of the best ways to quantify a company's lasting moat or competitive advantages is its return on invested capital or return on equity. But I prefer return on invested capital, as return on equity can be boosted by taking on debt, and also punishes the companies with large cash piles and no debt, which doesn't really sit well with me. But with Google, the return on invested capital has averaged 28.4% over the past 5 years and 35% over the last 10 years, which really demonstrates their everlasting economic moat. Anything above 20% is generally classed as top quartile. So when we think about Google's competitive advantages or edges, they are really by far and away the best and most used search engine in the world. They also have the best video sharing or online video service in the world. Both of these services are deeply ingrained in billions and billions of people's lives globally, and they attract an enormous audience and visitors every single day. And Google couple this with a targeted and more effective advertising by clever use of personal data, and no other ad providers, apart from maybe Facebook, can match Google in this regard. A good way to understand Google's motive by thinking about its competition. Who is next behind Google in search and online video? And really, it's not even close, and not really worth thinking about if your time horizon is 3 to 5 years. It has about 90% market share of the search engine market and has sustained this for over 10 years. They've also proven that they're COVID and recession proof this year, with revenue still growing in an economic downturn. So we're going to go over management on this slide and just check that off. One thing I'm not too happy to see is that the CEO, Sundar Pichai, his ownership of stock, with a total value of shares only reaching 23 million when he has been receiving an annual salary of 100 million for quite some time now. But other than that, you can't really fault much about the management and its past performance. So we'll just look through what they've done. And investments here, we've got, although there's been a few flops from the number of investments that they've had, 140 since its IPO. Really, there's only 2 that stand out there, which are YouTube and Android. And when you think about the return on these 2 investments alone, makes up for the 21 billion spent on the rest and much more than that. Products and innovation. Google has managed to enter new markets quite successfully, such as cloud, hardware, mobile operating systems, and virtual stores. Not only did they enter these markets, but they are front runners in all of those ancillary markets today. Owner-operators. The founders remain involved in the company to an extent. They've taken a step back from their past executive roles, but they still remain the group's largest individual shareholders and have the most voting rights. Performance and sustainability. So over time, management have built a financial fortress and a money-making machine. whilst also improving their economic moat and enlarging their economic moat every few years. Historically, they haven't made any stupid financial decisions, i.e. taking on large amounts of debt to accelerate growth and things like that. So buybacks, I want to touch on buybacks and what to do with all of that cash. So with 130 billion in cash on hand and 50 billion in incoming cash flows in 2021, they have the ability to buy back huge amounts of stock if no other good investment opportunities present themselves in the near future. So in 2019, they actually bought back about 2% of the shares outstanding. I'd imagine this will probably continue about 1 to 2% each year going forward, as unfortunately they're one of those companies that generates so much cash and has so much cash that it doesn't know what to do with it. But I haven't factored this into my core valuation just to be conservative, but I'll show you the effects of what that has on the expected rate of return once we get to it. But if you think about it, this really gives investors an element of safety when buying Google, because if the stock drops by a lot and gets really cheap, they're going to be buying back large amounts of stock and likely ensure that the price rises again. It is financial engineering, but it works. Apple's actually a great example of how effective buybacks can be to financially engineer stock performance. So if we look at Apple's earnings per share growth versus the actual operating income growth, and then we'll measure that against the stock price, you see that actually their operating income didn't grow too much. The earnings per share went up because they were buying back so many shares, and therefore the PE multiple was expanding because EPS was going up, and the stock price just started shooting upwards. Now, I'm not going to say that's going to happen with Google, but I'm just showing you how it's possible to financially engineer a stock performance. Now, it's not the core reason why we'd want to invest in a company, but it is something to keep in mind. So realistically, what growth expectations can we have? And what is the Google story? So just to clarify, the market will overreact to growth slowing down over time, just like it overreacts to growth speeding up. And we haven't seen the effect of this on Google yet, because it hasn't really been slowing, and they're growing at above 15%. They're growing at 20% over the past 5 years. It's obviously hard to grow at 20% year over year when your sources of revenue are maturing and you already own a huge share of your total addressable market. I'd say 15% is more of a fair estimate for Google, for Google's top line growth in the next 5 years. So let's break down how it will be possible that Google can grow top line at 15% in the future. So first of all, we've got the fast growing segments of the business. We've got YouTube revenue at 15 billion and growing at 30% year over year. It still has massive potential to probably grow at about 25% compounded into the future, doubling every 3 years, mainly due to the monetization process of YouTube still being fairly infantry compared to what its potential is. Cloud revenue at 9 billion and growing at 50% year over year. The total addressable market is also expanding, with cloud becoming a much bigger part of the world. This is one of the markets that Google doesn't dominate and has the potential to grow market share, although competition is fierce. Google's cash position, so they have a huge cash position. So if the right opportunity presents itself, they will likely take it. So think of when YouTube was bought in 2006, and Google has the ability to take a good company to a great company. They also have the ability, like we just mentioned, to buy back a huge amount of stock. They could potentially return 15% of the market cap to shareholders in 2020 alone. Market expansion, so ad market expansion. So when we think about global ad spending, there was $615 billion spent on ads in 2020 and growing at a 4.5% compound annual growth rate. So if we expand Google's total addressable market to advertising in general and not just segmented to digital or online, we begin to see some room for growth in the addressable market. And it's likely that other dominant ways to advertise, like say TV, will lose market share to digital companies like Google and Facebook in the future, just due to their more effective advertising, more targeted advertising through the use of data, personal data. Next, potential profit margin expansion. So this is something I saw looking at Google's cash flow and income statement. They spend $26 billion on R&D activities, well, $26 billion in 2019, which is 15% of total revenue. And this is a huge, huge number. If we add back R&D spending to Google's EBIT margin, it averages 43% over the past 3 years, which is obviously huge. Of course, R&D is a valid cost and it has to be factored in, and it's only useful when a return can actually be generated on it. However, Google's spend is currently 15% of revenue, and as the business continues to grow into the future, that percentage might drop, which will give us a higher EBIT margin. Some going concerns. So we've got growth slowing. As we mentioned earlier, the market overreacts to slowing growth nearly as much as it overreacts to accelerated growth. Also, they're already global and make up a huge portion of the total addressable market. But they can obviously steal a portion of the non-digital ad market, and not only that, but they can also expand into other markets like we've seen them do before. Let's just hope that in the expansion of the non-digital ad market, they're not beaten to the punch by Facebook or some other less notable competition. Next, the PE is 2 times higher than the growth rate, which usually means that there will be a multiple reduction sooner or later. For the US government suing the company for violation of antitrust laws, not ideal, but in my opinion, sounds worse than it actually is. The US's lawsuit is grey and lacks validity in my opinion. And that's all though. Really, I can't say anything bad about the company itself, which is always a good sign. Now, as we start to think about valuation, we need to come up with some projections for Google's future and pair the story and the Google story that we come up with some numbers. 5 years is going to be the period that we're using. I'm estimating that top line will grow at 15%, down from obviously 20% at the moment over 5 years from 2015 to 2020, but still a great number for such a large company. EBIT and pre-tax margin of 25%. So I'm going with EBIT as the earnings metric and terminal value estimated just because it's the most constant and reliable bottom line metric for Google, constantly staying around that 25% mark over 5 to 10 years, where the others have just strayed slightly. So I've gone with EBIT. Free cash flow should also grow at a similar rate to top line revenue, so 15%. But we've measured free cash flow with the sales to cap and capex approach instead. Sales cap ratio of 2, so this is the industry standard, and Google are approaching 2 in the trailing 12 months figures. They may get higher than 2 in less than 5 years, but I'll keep it at this level for now. Sustained tax rate of 15.5%. EV to EBIT multiple of 20 to get our terminal value in year 5. 20 times actually a conservative number in my opinion. The US market average, excluding financials, is 23 times, and Google's total addressable market is 28 times. But their enterprise value to EBIT multiple was dropped to 20 times 3 times in the past 5 years, which makes me think it could definitely be possible that we see it at that again in 2025. So in my opinion, it's better to be conservative than overestimate. And I'll show you though what 22 times or a 25 times multiple looks like also. Cash grows at a 10% rate, debt grows at a 5% rate. Shares outstanding remain flat, although it's very possible they'll reduce over the next 5 years. But again, I'd like to be conservative and leave the upside as a bonus if possible. I will demonstrate what a 1.5% or 2% reduction in shares will look like in the valuation model, just so you have an idea. So our methods of valuation will be a DCF analysis to get a dollar amount intrinsic value for Google based on a 15% required rate of return and a 25% margin of safety. We will also run an IRR calculation to get an expected rate of return from buying Google at the current stock price. Let's jump into the valuation model now and see what we have. Okay, so here is our valuation model. We've got our assumptions that we just covered over here on the left-hand side, the historical results for Google in the middle here. As you can see, we covered them, or the key metrics in the slides previously. And then we've got our forecasted period over here. We're going with a 5-year forecast period. So let's jump straight into the forecast. Look at revenue here. We've got 15% average growth rate over the 5 years, getting us to 345 billion in 2025. EBIT margin of 25%, as we mentioned. 86 billion of EBIT that gives us in 2025 also. Now, free cash flow, we're going from 34 billion to 65 billion, so doubling or almost doubling in the 5-year period. Total of 250 billion in cash flow we're going to receive, just in free cash flow we're going to receive over that time. Our free cash flow we are calculating with our sales to cap ratio above here. We're going with a sales cap ratio of 2, which will give us our cost of growth or maintenance capex. The free cash flow growth, here, is going to be tracking similar to the top line growth of 15%, although a little bit smaller. It's 14.2% as an average overall. Free cash flow margin averages just under 20%. It's at 21% as a 5-year average already, but trending down slightly in 2019, 2020 to just under 20%. So 19 should be fair. Shares outstanding staying flat as we mentioned, but I'll show you the effect of that dropping. And then cash growing at 10%, total debt growing at 5%. Now, the most important part of the valuation, or arguably the most important, the terminal value. We're going with a terminal value of 20 times EBIT for an enterprise value. That gives us 1.7 trillion in 2025. Now, I have got some comparable metrics here with EBITDA, net income, and a free cash flow yield, which is just the inverse of price to free cash flow. But as you can see, the average of all the 4 estimates gives us around about the EBIT multiple number anyway. So we're going to run with that. We've got a couple of relative valuations here for Google's TAM, the US market, ex financials, and then some comparable companies, giving us a much higher average. But like we said, 20 is fairly conservative, but we'll roll with the conservative estimate now. I'll show you what 25 or 22 might look like in a calculation in a moment. Now, off of that forecast or that terminal value, we've got less the debt plus the cash, a lot of cash there, and we get a market cap of 1.92 trillion in 2030, or a share price of $2,827. The intrinsic value is all of those cash flows, the 250 billion in free cash flow, and our terminal value. We're discounting that back to the present day. Sorry, that is. Discounting that back to the present day, discounting all of these cash flows back to the present day, the free cash flow we received here, and the exit multiple as well. That gives us a buy price of 746 billion currently, which is just over $1,000 per share. That's with a required rate of return of 15% and a margin of safety of 25. Now, I know we're quite away from that share price at the moment. It would have to drop a considerable amount to get down to where our buy price is. Now, I'm not saying that that's the correct price to buy Google. I do think that Google will always trade at a slight premium just because of the qualities that it has, and its almost everlasting growth, it seems. So maybe a margin of safety of 25 is too rich for a company like this. And if you're comfortable with I do think the forecast is fairly conservative. So you could drop that. The required rate, you could go with more of a WACC required rate, which would be about 9%. And you can see we get much nearer to the current share price today if we do that. So that's more of an academic approach to DCF. Whereas, if we're going with a investing approach and our minimum rate, we keep in mind our minimum rate that we'd accept and what our margin of safety is, we get slightly lower. But let's look at what that looks like in the IRR calculator. So in the IRR calculator, we've got our free cash flow per share, or our free cash flows that we're going to be receiving over the period, initial investment up front, and then adding in the terminal value or exit value we're going to get from the stock in year 5. That gives us an IRR of 17%, which is not too bad actually. It's obviously a market-beating return by some way, as you'd probably expect from Google. Now let's look at a couple of different scenarios and see how that affects our IRR calculation and DCF. So if we say that Google are going to continue buying back shares at a rate of maybe 1.5% over time, that obviously brings our share count down to 631 million shares in 2025, which boosts our IRR to 19%, boosts our buy price up a little bit to just shy of $1,200, which is likely, shares outstanding could easily start dropping down over a 5-year period. And that, to be honest with you, they should do. They've got so much cash on the balance sheet that they don't really know what to do with, and they've already started that process of buying back a lot of shares. Let's also say that the EV to EBIT multiple is a bit too conservative. If we went with a comparable option or relative option, then we should be, slightly over the US market average at least, because Google should trade at a premium to the market, like we said, because of the qualities that it possesses. So let's say the EV to EBIT multiple in 2025 was 25 times, which if it grows at 15% top line, there isn't any reason why it wouldn't be 20 to 25 times. That gives us here a much higher terminal value, 2.1 trillion in 2025, which moves our buy price up again to around about 1,400 off the DCF. And it gives us an IRR, as you can see, of 25%, which is a much, much higher return. I mean, that's an excellent return if they can achieve that. So you can see, as you start to play with the scenarios of what Google, has the potential to do, you start getting better and better returns. But we'll keep with our base case for now of 20 times EV to EBIT and say that the shares are just going to remain flat for now. And still a 17% return, 17% return really isn't anything to be ashamed of. So in summary, it looks like Google could be a buy at the current price if you are okay with a 17% IRR. Now, of course, these are only my estimates. These are my opinions. Always look into the numbers yourself, come up with your own story for Google and what its realistic growth might be into the future. But hopefully it was useful. Hopefully it gave you a better insight into Google and its operations, and also gave you an idea of what sort of return you could expect from Google if you bought today. If you liked it, please leave a thumbs up and subscribe, and you'll get a notification of when the next one goes up. And until next time, good luck with your investments.